Greetings, everyone. Good afternoon, good evening, whatever continent, part of the continent you are. Good afternoon, good evening, and welcome to First Thursdays. My name is Rahmat Infunjo, and I'll be your First Thursday host today. We're delighted that you have made the time to join us on this episode of First Thursdays today, and we look forward to an exciting session with you all. As you know, First Thursdays is a monthly event whereby agri-food businesses across the African continent come together to connect, gain new business insights, receive updates on new opportunities in the sector, and generally network with each other. And so we typically, make First Thursdays as connecting, as engaging as possible. Today, we will be discussing a critical topic for agri-food SMEs, and that's financing. By popular demand within the Nourishing Africa community, we have invited investment experts. We will discuss the two popular sources of financing for SMEs, debt and equity. As quite a number of people have actually registered to attend this session, I would like us to allow a few minutes really for others to join. So in the meantime, while we wait for others to join, we're going to launch a poll which will appear on your screen. I hope that I am audible enough. I can see in the chat that some people are saying that there is no volume. You might want to check your volume for that, but team members at Nourishing Africa, if you could confirm that I am audible enough before I go ahead.
I can hear you loud and clear, ma'am. Please proceed.
Thank you so much. Thank you so much. So we are going to launch a poll very quickly to get to learn about one another. So participants, of course, can also, know where you're joining us from. So I'll be doing that shortly. The poll should appear on your screen right about now. So please take the poll and let us know much more about you and your expectations for this session. In the meantime, I think we will take some more of that African beats and music just for about a few minutes so that we can have other people join in. But please take the poll in the meantime, just for a few seconds, please, to allow other people to join in. Please, let's go ahead. So I see that we are already going ahead with the introductions. I would think that those are the regular First Thursdays participants. So I would say yes, introductions are totally in order. As you're joining First Thursdays, please introduce yourself in the chat and let other participants get to know you. And I think we can get started at this point. We have quite a number of people who have joined already, and I'll get us started with the agenda. So first, we will have the introductions as per our custom, so we know everybody on the call. And then we will be sharing some opportunities for you, which entail opportunity for agribusinesses, specifically in the agriculture and food landscapes. And then we will go right into the guest speaker session, where our experts will be sharing the critical insights with us on the topic for today. We would have an interlude, and then we will go into the breakout room where we will be networking with other participants on this session. We can move on. All right, as to the introductions, I'm not sure the slides are moving. Okay, great. So I'll quickly take us through some housekeeping rules. If you're a regular First Thursdays participant, you already know the drill. First, we would want you to keep your audio off. First Thursdays is meant for networking, to engage and to connect. And that's why we would typically, have the audio and video available for you to use. But during the session, when we have the speaker session, we would want you to keep your audio and your video off. When we get into the breakout rooms where we can connect, then you can put on your audio and video to engage. The expression buttons are there for you to use, so you can use your raise hand button, thumbs up, clap, and etc., to call for attention. And of course, Nourishing Africa team members are available on the call to provide support within the chat. All right, by way of introduction again, my name is Rahmat Infunjo, and I'm the operations lead at Nourishing Africa. So we expect that every participant using the chat, drop your name, the name of your business, and your country of operation within the chat. Let's connect. Feel free free to engage somebody who might be in your focus area, who might be operating in your countries, and who might have similar business model with you. And that's the fun and the point of First Thursdays, to enable us to connect and gain critical business insights for our businesses. So let's move on. I hope that the connection is already going on. All right, for some of you who might not know about Nourishing Africa prior to today, I'm going to quickly, very briefly introduce Nourishing Africa. So we are a knowledge and membership platform aimed at helping African agri-businesses to scale. And we do this in 3 ways. The first being our membership portal. I am sure that a number of you are members of the Nourishing Africa community already. Through our membership portal, we have built a community of agri-food businesses. And recently, we actually we've reached the 1,000 mark, where we now support over 1,000 agri-food businesses across the continent, providing them with critical access to opportunities such as funding, data, learning resources, technology, inputs, and other resources to grow their businesses. We also conduct knowledge and capacity building, whereby we facilitate strategic, both offline and online convenings and trainings tailored specifically to agri-food businesses on the continent. We also implement support programs in partnership with development institutions critical to helping agri-food businesses rebuild, retool, and refocus their businesses, providing technical and financial support through these support programs. Slide can move, please. So up next, right before we go into the speaker section, whereby we will be discussing the agenda, the theme for today, we're going to take some opportunities. We will be sharing some opportunities with the agribusinesses on this call, ranging from funding to events to knowledge that can be useful for your businesses. And to do this, I will be inviting my colleague, Oladumade Otitola, to share these opportunities with us.
All right, thank you, Ramat. I'm Oladumade Otitola, and I'll just be taking you through some opportunities which you could access through the Nourishing Africa platform. And in terms of financial support, you could apply for the Launch Lab Agri and Data Startup Showcase. It's open to all countries, and Stellenbosch University Launch Lab presents this Pan-African Startup Showcase in conjunction with the SU Faculty of Agri-Sciences. It's set to, the deadline is for May 17th, so you should go check that out as soon as you can. Also, we have the Go Getters Agripreneur Prize for year 2021, and the prize aims to find Africa's brightest young agri-food entrepreneurs. It's also open to all countries, and the deadline is for June 14th. Also, we have the Milk and Motsepe Prize in Agritech, another opportunity that is available to all countries. And it is a global call for innovations and new business models to increase economic value for farmers in Africa from seed to scale. And it is also, capacity building. We have one from the Women in Africa for all countries, and its deadline is for May 7. So the Women in Africa opportunity seeks to endow 54 African women entrepreneurs from 54 African countries. And as said, the deadline is for May 7, so do apply as soon as you can for that. We also have the IKEA Foundation, which launches a new green entrepreneurship initiative, which seeks to advance green entrepreneurship around the continent. It also has a deadline for May, so please apply as soon as you can. And also the XGen Startup Ready program. It's open to all countries. It's brought to you by XGen in partnership with the Passion Incubator Lead Space. And while the deadline is rolling, you should check it out as soon as you can. Next, please. All right. So also still through the the Nourishing Africa platform, and by the way, I trust my colleagues will be dropping links to these pages where you can see more these opportunities and more of them. For the events that you can join, you could join the funding social change in Africa event brought to you on for May 7th. It's a webinar which you can sign up for through the Nourishing Africa platform. We also have the WSIS Forum, which is also happening on May 7th. And then we have the investment seminar session brought to you by AGRA and other partners. That is a seminar for May 10th. So you could apply or rather register to attend these events through the Nourishing Africa platform and other events you might also see on our events page. We also have the podcasts, and Nourishing Africa basically presents regular podcasts and recorded webinars from industry experts, successful entrepreneurs who share their insights on various aspects of business and agriculture in Africa. When you go to the Nourishing Africa platform and you go to the podcast session, you can see podcasts like this and more. Okay. For the trainings and workshops, we have an array of over 50 online courses through which entrepreneurs can improve their skills and gain knowledge on a variety of topics pertaining to agriculture, food, and business management. So just head over to the link, which you would see in your chat, to be able to access these trainings and more. Thank you.
Thank you so much, Ola, for sharing those opportunities. And of course, we hope that you will all go to the Nourishing Africa platform and will be able to leverage all of these opportunities to grow your businesses. And of course, there is a whole lot more, an ocean of opportunities right there on the Nourishing Africa hub for your use. And moving on, I wanted to comment on a couple of things. So I see that we have people still introducing themselves within the chat. And I would want us to quickly close the chat for now, so that as we begin the speakers session, as we have our speakers share insights with us. And that's really so we can focus on the insights that would be shared by the speakers. As I move on to introduce our speakers, I would like to first share the polling results so we can see all by ourselves. So I'll end the polling now. We have about 76% people already filled the polls. So team members, if you could help me disable the chat for now, so we can have a clear conversation. So here are the results. I hope you can see them on your screen. I can see right here that we have majority of people joining us from West Africa. So a shout out to our West African participants, especially the First Thursday's repeat participants who have joined us from last year, who have been joining the First Thursday session from last year. And we've seen that from the poll results that many of you are open to discover new opportunities for your businesses. Of course, you know that First Thursdays is the go-to event to be able to get access to these opportunities. And Ola has shared quite a couple with us already. So I would encourage us to go to the Nourishing Africa platform to explore these opportunities. And I can see that about 76% of us own agribusinesses and are looking to raise capital. I believe that this session would help us to gain that critical understanding of how we can do that, and considering both financing options that we have available to discuss today. And I see that we have quite a number of investors as well. About 10% of our participants today are investors looking to engage agribusinesses. I hope that we can all engage in the breakout sessions. And I see that more people have been able to raise equity for their businesses. I hope that you can share your experiences in the breakout room as well. And I see that we have 61% of you who are Nourishing Africa members. A shout out to all of you who have joined the Nourishing Africa community and are making the community worthwhile and a great learning experience for the entire community members. So I'll stop sharing the poll results now. A pleasure to connect with you all. Thank you for joining First Thursdays. So I will be checking on our speakers to see if they are with us. Lombe, if you can please unmute so I can check that you're with us. Share your video, please. Awesome. Thank you so much. Lelemba, awesome, thank you.
Hi, Rahmat. Yeah.
All right, so I'll just take a second to make you co-host now. I hope that you are now on. All right, so, you know, when it comes to a matter of financing, we've seen a lot of interest from agri-food entrepreneurs, really entrepreneurs everywhere. And today that we're discussing financing, and it is arguably the most popular topic among SMEs anywhere on the planet. And specifically, we will be addressing the question, debt or equity financing. Which should an SME be looking to raise? Which should an SME looking to raise capital go for? You know, I would leave it to the experts to discuss all about it. We've invited them to unpack this for us. So as we move into the panel section with the speakers, I would like to note a few things. First, we will have a Q&A session right after the panel. And I would encourage all participants to prepare your questions as the panel is ongoing. And then you would have to use the raise hand function to enable us know that you have questions. So during the Q&A, we will ask you to unmute and ask your questions. Again, for now, please mute yourself, and disable your video. Mute yourself and disable your video so that we can maximize the time we have with our two experts today. So I will go straight to our guest speakers. Our experts today are Lelemba Phiri, operating partner at Enygma Ventures, Lumbwe, investment manager at AgDevCo. I can still get some interference from some people. Please mute yourself and take off your video. Mute yourself. You can do that by yourself. Otherwise, team members at Nourishing Africa, please help me mute people. We keep the mute and video function on for you to enable you to network. So please do not disabuse this so that we can all have a fantastic session. Expert in the house. Enygma Ventures and AgDevCo are really specialist investors in the African landscape, and over the years, they have invested in a broad range of businesses. So you can be rest assured that Lelemba and Lombe will be providing very powerful, practical insights given their years of investment experiences on the continent. So let's get right into it. So first, I would invite Lelemba and Lombe to introduce themselves and tell us a bit more about their work at Enygma and AgDevCo. I'll start with you, Lelemba.
Hi, everybody. It's really exciting to be here with this group. We love the agri sector, and we're always looking for interesting businesses in agriculture. So I'm Lelemba Phiri. I'm based in Cape Town in South Africa. I'm the operating partner for Enygma Ventures, and we invest in women-owned businesses, particularly in the SADC region. We're excited about starting to look across the continent over the next few years. We mainly invest equity into investments, and so I'm really excited to be here with everybody. Last year, we invested over $3.5 million into 10 businesses across the region. And so we're an active investor. Even during the pandemic, we're happy to be supporting entrepreneurs who are well positioned for equity. And so looking forward to having this conversation with you.
Thank you so much, Lelemba. I'll go over to you, Lombe.
Hello. Hope everybody can hear me. Thank you very much for this opportunity. My name is Lombe Lumbwe. I'm an investment manager with AgDevCo. AgDevCo is an impact investor that follows a private equity model. We invest debt and equity across sub-Saharan Africa. Was split into three regions: West, East, and South. I'm an investment manager with our Southern region, which covers Zambia, Malawi, and Mozambique. When we say we invest in agriculture, we invest across the value chain. So this is anything from primary agriculture inputs all the way to processing. As long as it touches onto the agricultural value chain, it's something that we are willing to look at.
Thank you so much. And it's a pleasure to have both of you on the session today. So Lelemba, I'll come over to you as well. So you basically mostly invest equity in businesses. So I would like us to get started with the basics. So what is, I can hear some interferences. So please help me mute whoever that is. So I would like to get us started with the basics. Of course, I expect that many people already have the definition, but from an investor's point of view, what is equity? What is equity financing to you? What does it mean to you? And then over to Lombe for to give us an overview of what debt financing is.
So equity investment is where an investor puts money into your business and gets a share of your business. And so typically before we do this, we have to do a valuation process for your business. We both agree with you as the entrepreneur and ourselves around the methodology that we're using to do this valuation. And then we say for this amount of money, it means we're taking, say for this amount of money, maybe $1,000, we're taking 1% of your business. And so typically, we are not expecting for you to pay back. What we're looking for is that you grow your business and that this is a business that is scalable. And at some point in the future, when you've grown your business, how the investor makes money is that we look for what is called an exit event, where either a bigger investor comes on board and says they want to buy our shares in the business, or you're at a point where we can list you on the stock market, or a big organization like a large corporate says, oh, we want to buy you and we want to acquire you, or we want to merge with you. All of these are opportunities where an equity investor can then make their money by selling out their shares. And so I get that question a lot, like, when do equity investors expect their money back? It's not the immediate thing that we're expecting. What we're expecting from you is growth. And so we want to work with you to grow you to a point where you're so attractive that other investors want to come on board. And that gives us the opportunity then to make our money. Yeah.
Thank you so much, Lelemba. So I know that AgDevCo provides both debt and equity, and I would like Lombe to give us that sense of what debt financing means.
Thank you. So to use our standard definition for debt financing is when a firm or an individual looks to raise capital, either working or for a capital expenditure, by selling a debt instrument. Once they've sold this instrument, they essentially get paid for it and then need to repay this money at a specified point in time and a specified date. That's the standard definition of debt. Things that I would add to that is that it can take several forms. So you can have your standard trade finance or a bond, which I'm sure we've all heard of, or the regular 5-year term loans that most banks across Africa offer. Key differences from equity that should be noted, and I'm glad that Lelemba brought this up, is that debt has a specified exit horizon. So unlike equity, where you have to try to find your exit as you go along, with debt, you know that I need to repay this in 10 years' time, over 7 periods, over these 7 dates. You know that at the moment you take on this loan, and you know that you have to pay that interest. Another thing that separates debt away from equity is that it's usually secured against the assets of the business, and actually sometimes against the assets of the shareholders, depending on which lender you are getting debt from. In important aspects regarding security is that debt will always rank ahead of equity. And we never like to talk about this, but as a debt financer, you are risk averse. So you like to think of the worst case scenario. So in the case the business fails, as a debt financer, you rank ahead of the regular shareholders. So you get paid first. And if there's anything left over, then the shareholders get their part. And it's for this specific reason, although it doesn't always seem that way. And from our little poll that most people have actually raised equity, it's something that I've noticed. Debt is more expensive than is less expensive than equity. Equity is more expensive. That's because you sign up for more risk with equity.
Thank you so much, Lombe. I think it's getting interesting already. Debt is more expensive, equity is more expensive, if I hear you correctly, and that you get time period over which you have to pay the debt, unlike that of equity. So, when we're talking about debt or equity, SMEs, businesses would always ask, so at what stage of my business should I consider either debt or equity? And that's always one question we get asked a whole lot of time. So I'll put it forward to you now. At what stage should a business consider either a debt or equity financing? And beyond the stage of the business, what other critical factors would determine which option a business should go for? So Lombe, I'll start with you this time around.
This is a very difficult question, but to give you the most vague answer possible, it depends. It depends is the answer. So what I think an SME who's looking for debt needs to ask themselves a very important question. What is this debt for? What am I trying to finance in order to grow my business? Firstly, I believe that debt should only be taken to finance a business. Debt should never be taken to fund growth in a business. Often people accidentally take debt to fund historical losses or to fund losses in a bad year. Doing that has a compounding effect because you are being charged interest on money you've already lost. So it should always be to fund growth in my mind. So if you are trying to fund something to grow, that's a great position that you're in. What stage of the business life cycle you should be trying to fund debt at? So you can fund it at any stage, but debt financiers like mature businesses. As I was saying before, they are more risk averse. So they'll be looking for businesses that have a healthy balance sheet, a lot of assets which they can either take security over, or mature business with reliable and predictable cash flows that they can. So if you go to your regular bank, they'll ask you, can I see 3 years, 5 years audited accounts? And they'll take a look at that, put it into their very complicated systems and models, and it'll tell them how much money they can lend you. So essentially, at what stage? A more mature business will be able to find debt, will be able to raise debt much easier. However, you can get debt if... And it's kind of a chicken and egg situation, but a well-capitalized business with a management team with a lot of track record will be able to get some form of debt. So if you're trying to start up a groundnut farm and you've got the world's best groundnut grower and you've put in about 60% of the money, you might be able to raise debt from the right debt provider. But even in that kind of search, you may end up with some credit enhancements. Specifically for an SME, I would generally, you could possibly be able to find debt to finance some of your lighter assets. So if you tractor an easily movable type of assets, like untraceable type of assets, like a tractor, vehicle, a plow, you would be able to raise that kind of asset quite easy as an SME with a smaller balance sheet.
Thank you so much, Lombe. And I would like to say that we keep our microphone muted, please. I don't know if those are people who are just joining, but please keep your microphone muted. Otherwise, we'd have to disable the function for everybody. So I would go to Lelemba now to, give us that insight as to what stage of business is. What are your opinions? What stage of business is? Businesses be taking what type of financing, and what are the other factors that really should determine what business when they want to raise capital?
Hello, if you can hear me, please unmute everyone so that we can hear what.
Okay, I'm not sure I got that, but Lelemba, please carry on while I see what's going on.
Okay, so first of all, there are different types of equity investors that invest at the different stages of the business. When you're still in that early idea phase, setup phase, there are equity investors called angel investors that might be interested in investing in your business. These will be high net worth individuals that maybe worked in the industry where you're working, or they like you and your idea and excited about it. These are people who have excess money that they feel that they want to invest in a particular sector, and they might have expertise that they can support you with. And so it's possible quite early in your business to get an individual angel investor that likes your business or likes your industry and thinks that what you're doing is great and can invest earlier on. For venture capital and private equity, I'm in venture capital, which is the next phase. Private equity is slightly higher than venture capital. What investors typically want to see is that there is a clear path to profitability that you're going towards. It is, as Lombe has said, we're still risking a lot because we're not asking you for collateral. We're not saying we're going to withhold a particular asset for us to be able to invest in you. And we are hoping that what you are seeing in terms of your growth potential, you can actually make happen. And so that's why for equity investors, they take a share of your business, because what they want is also a level of involvement in deciding where is this strategy going, how are we going to open up networks for you to ensure that you're growing, in comparison to a debt investor who's going to say, here's the money, just make sure you pay back on the 30th of every month for the next 5 years. That's all, right? And so in terms of stage, there are different types of equity investors who invest in your business at the different stages of growth, starting with angel investor to venture capital to private equity. And then if you're big enough to be listed on the stock exchange, even individuals can just invest in you for, pieces of your business. And so with equity, you can invest at any stage. However, a caveat to that is that the longer you wait to get an equity investor and you grow your business, the better the valuation you're potentially able to get, because you would have proven that you can grow your business. And therefore, the less, amount of shares you are I give you $50, it means I have to take 50% of your business. If you wait until you've grown to a point where your business is, $1,000 and I'm giving you $50, it means I'm taking less percent of your business, right? And so thinking through proactively, how can you be resourceful in your earlier phases? And a lot of entrepreneurs have really worked a lot with family and friends at that very, very early stage, getting money from family and friends, stitching the money together in order to set up and start growing. Because the bigger you grow, the stronger you can show that you can actually create traction and grow the business. The more we as equity investors, when we see your future plans, will believe that because you've shown some history in the past, which means your valuation will get better. So in terms of stage, equity can be invested at any stage. Secondly, use of money is really important to consider. What do you want the money for? If you want the money to buy an asset, for example, you want a machine for your farm, equity investment is not the thing for that. Just get a loan for that, because you can actually secure the loan against that same asset that you're buying. If, for example, you're saying, I'm selling to a big store, supply chain, I'm supplying my products, say, into ShopRite, and what I need is an injection of money to wait until my payment comes in 3 months. Again, that's not for equity investment. you can get a bridging loan for that. So thinking through the use of the money, what do I want to use the money for, is very important. Equity investment is key for when you've got plans for scale. Scale means that you've found a way to really multiply the growth of your business, maybe even up to 100 times. Sometimes it could be that you figured out a good distribution channel that can help you distribute your products. Maybe you're using agents, maybe you're using a franchise model, or you figured out that with the use of technology, I am able to supply my service across a number of countries and markets, stuff like that. That is where equity becomes super useful. But if it's a once-off thing that you need, I want to buy a machine, I want to extend my farm, that type of thing, you're probably better off just getting a loan that you can pay off according to how long your asset, will last. If your machine lasts 3 years, pay it off over 3 years. If it's a land extension, you can even get a mortgage, a bond where you're paying it over 20 years. Fair and easy, straightforward, instead of giving away parts of your farm. And so the use of the money is also important for you to consider. What do I want to use the money for? And therefore, what type of financing best fits this? Lastly, how much money do you actually want? If it's a smaller amount of money where I need it quickly, how much do I want and how quickly do I need it? Just go and get a loan. And, as long as you've got a plan for making the money back, to pay it back, get a loan. If it's a bigger level of injection where you feel that, okay, this can really help my business grow over X amount of time, and I'm not 100% sure how long it would take me, that's where you might want to consider equity. And so things to consider is the stage of your business, therefore what type of equity investor you get, what am I using the money for, how much money do I want, and over how long. And lastly, got to repeat, the best source of financing is always sales, because a business that can sell is a business that can actually grow organically. And so if you are starting the business without seeing the possibility already of you being able to sell stuff to grow your business, then maybe that's not a business. Maybe, it's a hobby. And so whenever you are thinking of all of these things as sources of financing, sales should be your number one place of call. And you're thinking about how can I grow my sales as aggressively as possible, as quickly as possible to grow my business? Because we know from every sector, there have been billion-dollar businesses that have grown organically, meaning purely out of their own sales and their own fuel.
Thank you so much, Lelemba, and thank you, Lombe, for that introductory aspects as well. And I hear you loud and clear. And I really like what you said about sales being the first point of call. And many entrepreneurs, as soon as they get started and they just want to buy a machinery, they're looking for loan, they're looking for an investor who will take up some percentage. And that's why I really liked what you said about sales. Sales is the first, financing that any business should be considering. And, just to wrap up what both of you have said, and I'm beginning to see that divide between the debt and the equity financing. And I'll come right back to that. But just to cap it, you've said that the stage of the business is really critical to know what type of funding should the entrepreneur go for, how much money is needed. I really like that in terms of, many times, so many entrepreneurs would just, put a figure to some sort of need for their businesses without considering what funding type actually would suit that figure that they've put out. So it's a whole lot of insights that both of you have shared. And I wanted to ask again, so when we're talking about debt or equity, and you've given us the differences, right, and how to determine what to go for, I would ask, so can a business actually combine both types of financing? I mean, debt and equity. And when we're talking about combining both types of financing, what are the implications? If, for example, over the last few years, I'm still repaying a debt, and then I want to also consider equity. So what are the implications for the business? And what would actually constitute a reasonable and attractive debt to equity ratio? And I would go to you, Lombe, for this one.
Yeah, so it's very easy. It's very possible for any business to combine debt and equity. You can. I think it's actually something that you're having the correct combination for your business is key to unlocking sustainable growth in your business. But what is an attractive ratio is something that's very difficult to land on. It's very much what is attractive is dependent on your product, what you're selling. Also very much dependent on your risk appetite. So if I'm if you're sitting in equity, I presume that you're quite you've got a high risk tolerance, but even equity holders have a limited risk tolerance. Some don't want to risk their businesses. You'll find some family businesses that have never taken a loan before. They prefer to finance everything out of their own pocket. This is because maybe they've had a bad experience with the bank. That's an equity investor who's also risk averse. While there are some businesses who literally the owners may not have declared a dividend because the business is so highly geared that they are constant. There's barely any free cash flow left, but the business is growing rapidly. I think it all comes down to what is best for you. So in my opinion, I would never advise someone who has just started a greenfield tree cropping plan like avocados to take on a lot of debt. By the time those avocados start fruiting and start providing you any cash, it's 5-6 years down the line. And you've been paying interest and principal back for 5-6 years before you've made a single dollar of what you took debt for. So I'd expect such a business to have a lot more weighting towards equity, while a business like a Miller would have your regular 50-50 combination of debt to equity when you look at it at face value. But then they would also have thousands of metric ton of grain stored off-site, financed with off-balance sheet financing, which is really debt secured against a portion of equity you paid. So it's very much dependent on your business, but you need to get the correct mix. I would look at it from a debt-specific point of view. I'm very much cash flow focused. You never want to, any conversation that starts with me thinking about if this person fails, then I'll be selling their farm is not a good deal. Like if I'm already thinking about it, it's not a good deal. I don't have faith in it. We shouldn't be doing it. But if I have faith in the cash flows or the potential cash flow generation, then that is where it should be. And if as an entrepreneur, you should be looking to keep your cash flow ratios to the amount of debt you're paying back at a healthy level. So it's not about the amount of debt you have, but the amount of debt you can service. So if you are generating, in finance, you call it EBITDA, earnings before interest, tax, I would want you ideally to be 3 times that should be the max amount of total debt you should possibly be having at any one time. So if you make $500 a year, definitely more than $1,500. That would roughly be where I would want to see.
Thank you so much, Lombe. If I hear you correctly, you mentioned that many of those factors that determine what type of funding you should go for actually applies to the mix that you should also consider as well. So if, for example, as you've used that you have a long repayment period, then you should be considering a small percentage for your funding mix than debt financing. So thank you very much for sharing that. I'll go over to you quickly, Lelemba, so that we can have some questions from the participants. I know that many of them would have questions for you guys already. And I'll say, so for equity funding, we've made the various cases for both debt and equity funding. But for equity funding specifically, I know that many entrepreneurs are very cautious about giving up their shares to investors. So let me see what's going on with that sound. I trust that my team members would handle it, so I'll go ahead with the question. But I'll confirm that you can hear me, Lelemba. Okay.
Yes, I can.
Yes, thank you. So I'll say that because many of the entrepreneurs are cautious about giving out their equity to investors, but in most cases we have seen that it's really about the knowledge they have about their company valuation, for example, and how to go about the investment negotiation with the potential investor. So how do companies like yours, like Enygma, actually value businesses when they want to make an investment in the company? And what factors do you as an investor consider when negotiating shares distribution with a potential investee?
Cool. I think that's the question that comes up all the time with entrepreneurs in terms of what do investors look for when doing the valuation for a business. So a number of things. Number one is your current EBITDA, which is your current profitability level. As Lombe said, that's important both for debt and for equity, because if you're considering debt, again, you shouldn't be taking out debt that is 3 times more than your EBITDA, because it means you probably will not be able to service that debt. And so we look at that as well, because at the end of the day, we want to see a clear path to profitability. And so if your EBITDA is currently negative, we want to see that in the forecasts that we're going to make, number 2, that there is a clear path to seeing your profitability actually happen over the course of 18 to 36 months. Beyond that is too much. We've got people who do forecasts for 10 years and they are still in negative. An equity investor is not going to be interested in that business. You have to think clearly about a clear path to profitability if you're not profitable over the next at least 18 to 36 months as a maximum. So number 1, current profitability. Number 2 is your future projections. And we want to see growth happening when you're making these projections. So equity investors look for scale. This means that if today you are making a profit of 1 without the investment, we want to see that with the investment, you are able to turn 1 into 10 and 10 into 100 over the next amount of months. And what we don't want to see is that for every dollar we're putting in, you are spending another dollar again, which means you're not growing and you're just remaining stagnant. So scale talks about replicability, but it talks about high profitability as you put fuel onto this business. And so we want to see that from today, you are making 1 in terms of profit. Tomorrow you can make 10, and day after tomorrow, not typically. So this is probably over a 3 to 7 year period. You could actually grow to 100, And so we look at the future forecasts to see how big you can actually grow. Number 3 is we consider the market. How large is the market that you are actually looking to gain? Nowadays, it's easy to do a little bit of research into your product market, if I'm doing groundnuts, how big is the groundnut market? So how large is this market and is it growing? Because the more it's growing, the more attractive your business becomes, obviously. And so you need to know how large this potential market is able to be and how much of it can you actually get? Because you might tell us this is a $500 billion market in the world, but where you are sitting in Lusaka, Zambia, you can only access $1,000 of that $1 billion. That doesn't make you attractive. And so knowing how big your global market is important, but also knowing what is actually accessible to you and what you can get, what you can actually obtain is important. Lastly, we think about the risk. How much risk is there that you actually won't make this plan happen? Because unlike debt, we're not getting any collateral. There's nothing to guarantee that we'll get our money back. And so we have to consider the risk factors before we make this valuation and make this investment. It's things like how strong is your team? Can this team actually execute? How possible is it to get good, capable people to get into your business and your team to make this plan happen? And lastly, how much debt do you have? The amount of debt that you have reduces your valuation. And so this ties in again to thinking critically about your equity and debt mix and when you get what type of financing. If you've got too much debt, it decreases the valuation for your business because we have to consider the fact that you do have to pay this debt back, which means you might use some of this money that we're giving you to paying debt back instead of for growth. Noting that equity investment is always done because we want you to grow so that we can have an opportunity to exit. And so if you've got too much debt, it counts against you and we're going to remove that from your valuation. So those are the things to consider.
Thank you so much for sharing those. And I'm excited that you talked about risk. I mean, you check the risk of the business when you're about to invest in them. And that's one thing about investors as well. So many investors would typically, as you've said, consider the risk. And I've seen that, at least from the feedback we've had from the entrepreneurs that we're working with, many investors consider agribusinesses as extremely high risk. However, both your organizations I've seen have invested, they have portfolios in the sector. So how do you work with agribusinesses to mitigate the risk that you've talked about here? What conditions and requirements are required either for in investing in agribusinesses for equity and for debt. And I would want both of you to address both from the equity and the debt point of view. So I'll come to you, Lelemba, for the first response to that.
Mm-hmm. So we consider both, I say that both the driver and the car. And so when we're making an equity investment, because we don't take any security, we don't know if this story is even going to happen, we have to consider you as the entrepreneur and what is the evidence that you can provide us to show that you can actually make this plan happen. And so everything that you've done in the past where you've made a success of yourself matters to bring to the story to the table. So if, for example, you are just starting out in this agribusiness and you say, I've never done this, but I really believe I can make this $1 billion business, you are less believable than somebody who's actually grown a business before or grown this same business and has seen results. And so traction is evidence of having achieved something is important, whether in your current business or in your past life. That is important. What we want to know is that you as an entrepreneur are actually teachable and that you really can grow and change as circumstances happen. Entrepreneurship is tough, whether you're in agri or you're in technology, whether you're in education or you are in electricity, entrepreneurship is tough. And so being teachable as an entrepreneur is really important. And we want to see those qualities coming through with some proof from your past. And so it's not unusual for an equity investor to do a background check on you, for example, that they're going to do because they have to see what type of person you actually are. We want to see that there's a team, because if you're the only solo person, yes, okay. So if you're the only solo person in a business, no worries. If you're the only solo person in the business and something happens to you, it's possible that the farm goes down or your processing plant goes bust. If you've got a team, the better, because then there's some level of continuity that can happen with a business, whether you are there or not. So we just don't look at the business and the business growth and the business's ability to get the market. We also look at the individual's ability to actually execute on the plan. And with this, we need as much evidence as possible. There's some prayers going on in the background there. So yeah, so we look at both the entrepreneurs and the businesses to make sure that we can eliminate as much risk as possible. And agri-specific, there's so much that we have to consider in terms of your suppliers, for example, and your distribution channels, for example. All of these count to how confident we are in actually growing your business and investing in your business. Yeah.
Thank you so much for that. I mean, that's really powerful and it's really critical insights that every entrepreneur needs. But before I make the final round of comments, I'll go to Lombe for his insights before we wrap up and begin to take the questions from the participants.
Yeah, so how do we mitigate risk? So for perspective, AgDevCo is actually a company. We do both debt and equity because it's very difficult in agriculture to mitigate risk. I've kept most of my comments strictly for the purer forms of debt. There's things that we call mezzanine finance, which just sit between debt and equity. But how do we mitigate the risks? So there are things that you'd like to see a business that has some of the basics for agriculture that allows you to mitigate risk. And the risk that you normally find, for me, I break it down to 4 things that I want to see. Mainly, I want to see reliable access to water and energy. While I can have as much faith as the next man in God, I do not want to be praying for rain. I'd like to give him a break and make sure that I'm near a river, that he's got many problems to deal with in this world. So reliable access to water. Energy is something that's taken for granted. A kilometer of power lining can cost astronomical. So being close to it and it being reliable is important. You don't want to be irrigating a crop and then have no power for 2 days so that you can get water on it. So reliable access to water and energy. is a mitigation. If I don't see this, then I am probably not giving you any debt. If you do not have land access, so that's important from both the fact that I don't want you losing your land halfway through our 10-year loan because it was not properly signed off, but also because land is it's the most tangible form of security. It's immovable, it's traceable. I don't know about other jurisdictions we have on the call, but I can walk into the Ministry of Lands right now and see who's owned a piece of land from 1940 and how many times it's changed hands. It's traceable. After that, we are dealing with agriculture. Don't forget we're dealing with food, so health and safety. No one is giving you money if you're producing something that's making people sick. So those three things we will ensure in my process. In order to invest in you, we'll make sure that these three things are as top-notch as possible. We are non-negotiable and non-negotiable situations. These need to be dealt with. After that, it's, for me, just as important, and Lelemba touched on it, is management is key. You want someone who knows their school fees. So I'll always advise somebody who's trying to do something, before you present your big idea that's going to make billions of dollars, millions, I would prefer a balance sheet. I would rather have a conversation with someone who has a balance sheet who has lost $20,000, but has an EBITDA level, has a positive gross margin. It tells me, as long as their accounting is right, it tells me that they have a model that works that just maybe needs to be scaled. But those $20,000 of losses are school fees. It's $20,000 of mistakes that they will not make again. So when you see somebody who has 10 years of experience, I don't want them for the 10 years of everything they got right. I'm looking for the things that they got wrong and will never get wrong again, which is very important because I need stability as a debt investor. So that's very important to me. An aspect for management, however, that's also important, and it's also important for the owners, is there's 3 C's by Tony Talk coming to my head: credibility and character. You need the people you're working across the table with need to know that you have uncompromising character and high levels of credibility. You don't want to be who we've done this, probably these small loans, guys who call you 2 hours before they're supposed to pay you back saying that they can't pay you back. That doesn't help your credibility. You want the guy who calls you 2 weeks before and says, I have a problem, because they look about their character, they think about their credibility, and don't want to look like they're giving you a bit of a runaround story. So that's it for me.
Thank you so much, both of you, for sharing those. I mean, I cannot even begin to recap all you have said. I'll give it a good shot. I hope that all the participants have taken good notes from all you've said. So I'll take everything at once in terms of, just starting from what Lombe has said in terms of the business itself, the access to land, the access to resources, the team, very important. And we've had these countless times, and we advise the entrepreneurs that we work with, be deliberate in choosing the people who work for you. You as an entrepreneur need to also build your skills. You have to accumulate, knowledge and capacity from various avenues that are relevant to your businesses. And that's why we're very deliberate and particular about that. And through these sessions like this, we're able to, be able to build those capacities for them. You've also mentioned a lot of things regarding the current profitability of the business, the future projections for that business, in terms of being able to understand the landscape. You mentioned that as well. Be able to understand the market size and know what part that business plays in the market and what size of the market that business can potentially capture. I mean, those are just a few of what you've mentioned, really, and we cannot thank you enough for the critical insights that you've shared with us. I think we have some 5-10 minutes to take a few questions from the participants who might have other questions. I believe that we've covered a whole lot of ground, but possibly there are some questions that participants might have. I would invite my colleague Jane to do that while I quickly sort out the breakout room that will occur right after the Q&A. So Jane, if you're there, we have about 9 minutes or so for the breakout. So I would want to say that for this Q&A, you have to raise your hand, use the raise hand function. If you talk out of turn, we will take you out of the meeting. So you have to raise your hand, and Jane has to call your name for you to ask your question. We want it to be very orderly, please. Jane, over to you.
Thank you so much, Ramas, for that. So I'll be hosting a Q&A session, and I need your hands to be up. When I call your name, please stay close by your speakerphone so that you can ask your question immediately. And everybody has 1 minute to introduce themselves, their businesses, and where they're coming from. And then you ask your question. So for the first person, Femi Aki, Food Locker, I would please unmute yourself and ask your question.
Hi, everyone. My name is Femi from Nigeria, Food Locker. I just want to understand from the perspective of the equity investor. You talked about exits in Sub-Saharan Africa being sort of one of the drivers for how the equity investor wants to cash out their own money somewhere down the line. Are there particular exits within the ag sector that you've seen, or in the ag tech sector that you've seen, which sort of give us an idea of the kind of exits that exist within the Sub-Saharan Africa sector?
Yes, absolutely. Both of us are equity investors, by the way, so Lombe can share his thoughts as well. We are seeing a lot of acquisitions from bigger, either farms or stores. The big supply chain stores like the ShopRites, the Pick and Pays across the continent are buying a lot of ag tech platforms, particularly because they're seeing how these make their whole supply value chain a lot easier. We've also seen a lot of agribusinesses actually listing on stock exchanges as well, which is pretty exciting. And some listing locally and internationally, like on the New York Stock Exchange and the London Stock Exchange. And some mergers where different startups and SMEs come together to create a bigger platform, which incorporates maybe different parts of the value chain. And maybe if one was solving problem at the lower end of the value chain and one is solving a problem at the upper end, they come together and create something a lot more valuable. So it is an exciting time and it's an exciting space. And so there are a lot of options. And every equity investor, not just in Sub-Saharan Africa, has to look for an exit. And so we keep an eye on what is happening so that we can best position any of our investments in front of these opportunities all the time. Yeah. Lombe, do you want to add anything?
I think that was perfectly answered. Just to add, this there's also private equity money coming in, and you would also find people horizontally integrate a lot. So an example would be if you had large-scale cattle farmers start buying out butcheries, start buying out abattoirs, and so forth and so forth. So it's a popular model to control in Africa to control a lot of the value chain. It helps with risk management.
Okay. Thank you so much for the answers. So for the next person, I'm going to call Brian. Brian, please unmute yourself and ask your question. Can you hear me, Brian?
Hello? Hello?
Yes, you're on. Please ask your question.
My name is Byron Tawengwa. I'm from Zimbabwe, but I'm operating from Abu Dhabi. I just wanted to ascertain from Lombe to say what is the minimum size of the tickets, minimum ticket size, and what is the maximum ticket size?
Specifically with regards to AgDevCo?
Hello?
Sorry, Brandon, that's specifically with regards to AgDevCo in general. With regards to AgDevCo specifically, ticket size can range from about $1 million to $8 million, but it's a very wide range, very much dependent on the needs of the business.
Okay. Thank you. So we'll move on to the next person, Godwin Eka. Godwin, please unmute yourself and ask your question.
All right. Can you hear me?
Yes, you can.
Okay. The question I want to ask is that my business is viable, the market is there, but I have problem with liquidity. As in, I have problem getting enough money to supply. But at the same time, I don't want to go into borrowing. I need equity investors. So the challenge is that I don't have records to show, but the business is viable and you can generate income. But if I invite them to come around, they will see that I make sales. But the question is that I want them to partner with me in form of equity investments, and then we share in the return. So in this case, how can this be done?
So your problem right off the bat is that you don't have records. You are trying to get a story. So an equity investor coming outside doesn't have access to the things, your day-to-day stuff that you go through, that's able to tell them that you are able to generate the money. Your records are very, very important. They're the story. If I am going to invest equity into you, I am going to get your last few years worth of accounts. I'm going to see your balance sheet. I'm going to see your cash flow. And it's essentially, I'm going to make sure that ties up with what you are telling me. So you tell me a story that I got this much money, we built this farm up, we started selling this much, our sales went from this to this. Your exact story should reflect in those financials over the last few years. So without those records, you have a problem with regards to raising equity. We have very limited options with where we're going to start a valuation. So the only person who will be able to actually give you money in this case is probably your banker, because your banker can go into your account and literally create those records of your incomings and outgoings, while us on the outside as equity investors can't. So this is why banks are able to provide working capital a lot much better than most non-deposit taking institutions.
Okay, thank you, Lombe, for that. We have time for just one more question, and I would call Ozomena, EcoBeans Farm Enterprise. Please unmute yourself and ask a question.
Good evening. My name is Ozomena Ekweme, EcoBeans Farm, operating from Nigeria. Please, I would like to deviate a little bit from this equity and financing session, because my question is going directly to Nourish Africa about the problem we have.
Sorry, I would have to come in here. The questions should be directed at the speakers. If you have any questions for Nourishing Africa, please send them to info@nourishinafrica.com. Thank you so much. All right, I think that can close us out of the Q&A session. Jane, you can help me mute other people and lower the hands. I would say a very big thank you to Lombe and Lelemba. You have been awesome. You've shared amazing insights here this evening, and I'm sure that our participants agree with me. So on behalf of Nourishing Africa, on behalf of the participants, a big thank you so much for all the insights you've shared. And I would want to say to the participants, if you have further questions, please feel free to share with us via email, and we will try our best to get you the answers required. And to Lombe and Lelemba, I would encourage you to stay for the breakout sessions, for possibly you still want to engage a few more agribusinesses, and vice versa within the breakout rooms. So very, very quickly, so that we can go into the breakout rooms to network and connect further, I'll take us through the interlude right before we go into the breakout rooms. So for the interlude, we'll just be discussing, some next steps to enable us solidify many of what we've learned today, and provide further opportunities for more engagement and opportunities. So let's move the slide. First, I'll talk about the Nourishing Africa membership. We've seen that more than 60% of the participants on this call are members of Nourishing Africa. Again, a shout out to you, and I hope that you're gaining value for your membership. If you're not considering the Nourishing Africa membership, can you mute yourselves? you're not constantly signed in, you have to sign into the portal to gain access to all the resources that we've talked about. So there are various opportunities for you within the membership portal. We consistently showcase opportunities within the portal. If you're a member, you have to log in constantly. If you are not, you can join the Nourishing Africa through these 5 easy steps. One, you have to go to the hub, you have to go to the entrepreneur section of the hub, and there's a sign-up form for you to submit information about your business. You submit the form, and we will review your application for membership. Of course, you have to be an agribusiness that have been operational for about 6 months. And on the screen, you can see the various range of opportunities that we share with our members, from funding to access to customers, distributors. We consistently help our members to look for new opportunities to showcase their businesses and sell their products. And of course, if you would like to receive updates from us, you can follow us on social media at Nourish_Africa on Instagram and Twitter. And of course, we're on Facebook as well. And you can subscribe to our newsletters to receive weekly opportunities specifically for agribusinesses within the African continent. Move the slide, please. And I think possibly after this, yes, we would love your feedback about this event. Let us know what you think about this event. And this is, through this survey, is actually how people have been able to tell us they want us to discuss debt and equity next. They want us to discuss a range of topics, market access, this and that. So by participating in this feedback form, you're able to tell us directly your opinions, and trust us, we pick your opinions from there and we act on them. We are here for you after all. So I would want us, now this is the stage where we're supposed to turn up our videos. Many of us have been going against our instructions. We like to keep our first Thursday session open, but these days you are making us regret those decisions, because many of you will unmute out of time. But right now, you can please put on your video. Let us take a group picture for our social media pages. We'd love to tag you, so you can drop your social media handles in the chat so that we can tag you when we post the picture. So please turn on your video. Let's take a quick group picture before we go into the breakout rooms. And of course, if you've joined First Thursdays before, you know that I love the smile. So please put on a smile for the camera if you can help us with the group picture. We have to.
Three pages, so please give me a moment.
All right, thank you.
Thank you. Thank you, everybody.
Thank you.
All right. So I think I see that Lombe has to jump off to another engagement. So I'll say again, thank you to you, Lombe and Lelemba, for the awesome insights you've shared with us. We can take off our audios, please. So now we will go into the breakout rooms. And the instructions are really simple. If you've joined First Thursdays before, you know that the breakout sessions are where you can engage with the participants, generally share your experiences. And for these breakout rooms, we want to hear from you. We've heard from the experts, we've heard from the investors. We want to hear from you as the entrepreneurs. Have you raised funding before? What are the challenges that you've seen, either for debt, either for equity? You know, sometimes we have the entrepreneurs saying that these are my challenges. Maybe the experts have not, mentioned it. So you can let us know what your individual experiences are, so that other people can learn from you within the breakout rooms. And of course, connect with other entrepreneurs within across the continent. Geographical location is no longer a barrier. So it's an open forum for both investors on the call and the SMEs on the call. So I will open the breakout rooms now, so we can all go into the breakout room. So the prompt should appear on your screen. The prompt should appear on your screen right about now. We have about 15 minutes. From the breakout rooms, you can actually leave. Once the 15 minutes is over, you don't have to come back to the general room. The First Thursday session is over. And here I would like to thank you so much for attending. We hope that you connect and gain various, new connections within the breakout rooms, and possibly maybe connect with an investor looking to, engage your agribusiness. So thank you for your time. See you in the breakout rooms. Bye-bye.
Ramat,
Yes,
the
Jay.
breakout rooms have closed. We are all back to the main room. The breakout rooms have closed.
That is very strange. I would open it up again, but I'm not sure what's going on.
equity was talking about. Because from what the lesson I've taken so far, the explanation they've given by Lombe and Lelemba, they just explained debt and equity. And I'm sorry to say, my business is not that large because Lelemba just said before we go into debt, we must be sure our business is big. And so that we can't go for debt, and at the end of the day, we are paying back and we are not doing well. But under equity, my problem now is I would have say I need equity finance. He just said that they are looking for good
It's breaking, madam.
From your big
so the loan is supposed to be for 3 years, and I had a 1 year moratorium. I don't pay back anything within 1 year. So I just start paying back from the second year, and the interest rate is between 5 to 9% thereabout. So it's very easy for me to pay back. So that's my feedback.
Thank you for that, Femi. So that even brings me to this. Do we have any investors in the house who are looking for businesses to invest in? I mean, you just tell us the type of businesses you're looking for, and just maybe one of us here has that business. Okay, if not, if you Chris, your hands are up, so please go ahead with what you want to say.
All right. Good evening, everyone. Hello, can you hear me?
Yes, I can hear you.
Good evening, everyone. I want to say a very big thank you for this privilege. I'm Ifi Chris. The name of my company is Ifi Chris Agro Fish and Birds Farm. I'm not an investor anyway. I'm into agriculture too, but my concern is for these investors, do they also share in the risk that may arise? Can you hear me? It's like there is noise on the background.
Yes, I can hear you. Please, if you're not the one speaking, if you're not Ifi Chris right now, please mute yourself.
Woody, I can give you cash.
All right, so are the investors for the equity, are the investors also partaking in the risk if there is any loss that arising because of the business, or is it just about gain? Because I know some businesses that during economic recession in Nigeria, I'm in Nigeria currently, recession, and even during the COVID-19, some of the imported goods were not really coming in, and most people that have one or two things to do with imported goods for their businesses, they were really affected. These investors, are they also part of the risk that become, or is it just gain? Thank you very much.
Thank you, Ifi. Please, does someone want to answer her question before I just chip in a bit in that? Who wants to give it a go? Who has had experience with investors? Do they share in your risk? Do they just come and take?
I just joined the session and I had Ifi Chris ask the question. So Jay, I can quickly step in.
All right, no problem.
All right, thank you. And thank you so much for that question. We just have like 2 minutes for the session, so I'll quickly answer. What I've seen is that there are many types of investors, and that's why the entrepreneur have to do their due diligence. First, understand what kind of investor that is. As we've heard from Lombe and Lelemba, you have the investors have their focus. They are not looking for everybody. They're looking for those who fit into their own profile as well. So the entrepreneur, the business has to do the due diligence. what is the track record that the investor have? You just don't want anybody to invest in your business or to have equity. So you have to understand what level of risk do they take? How do they support the business? Are they interested in your growth, or are they interested in their money? Are they interested in supporting you for over the years? And even after they've exited, what kind of support do they even provide? So you have to do your due diligence. Otherwise, you might be falling into the wrong hands. Many of them take risk at different levels. Some will be with you for the long haul. Some, they're just there for their money. So I would encourage entrepreneurs to, do their due diligence before they engage any investor at all, be it debt or equity. That would be my contribution. Thank you.
Thank you, Rahmat, for that. So we still have about 32 seconds more. Does anyone want to say something? Any final words before we go? I hope Rahmat answered your question properly.
Yes.
Hope you. All right. Thank you.
Thank you.
Yes, I'm okay now. I'm good.
All right. All right. Thank you. So
thank you
the
so
time
much.
is up for Breakout Room. Thank you all for engaging so well. And I really want to see all of you for our next First Thursday session in June. Thank you.
Thank you. We look forward.
And please fill out our survey so that we can make the next session better than this. Thank you very much.
Thank
You're welcome. Yeah.
So we can leave.
All right, I see that a number of us actually are returned to the main room. So, but I know that we've said the goodbyes before from the Nourishing Africa team. It's goodbye. Thank you so much for joining this session. One, please fill out the survey form so that we can get your feedback. If you're an entrepreneur, join the Nourishing Africa platform, www.nourishinafrica.com. And if you're a member, make sure that you sign into the portal to get updates and to sign into our newsletters. Thank you for joining the session. Goodbye and have a wonderful evening. Till we see you in June for the next. Bye.